Welcome to the Financial Management module on financial reports. This module is part of a series of e-learning modules designed to foster and develop the financial management skills of people working in global health. Each module will offer an opportunity to learn from experienced managers and to engage in learning activities that are designed to apply the skills and concepts to your own professional setting. This e-learning module was produced by the University of Washington Department of Global Health, based on content from the Financial Management Essentials Handbook developed by Mango. Mango is an award-winning UK charity whose mission is to strengthen the financial management and accountability of non-governmental organizations around the world by providing innovative, high-quality in-person trainings, consultancy and recruitment services. This module provides an overview of the basic content, but not the full experience of attending one of Mango's practical and participatory training courses, where the motto is taking the fear out of finance. A library of Mango's own publications, as well as information about their services and their open training program, can be found at the Mango website. We encourage you to visit this resource of information on financial management and accountability. When you have completed this lesson, you'll be able to describe the key elements of financial reporting, explain how to interpret financial statements using trend and ratio analysis, and how to compile and use the information in management accounts. You will also be able to identify important features of donor reports and understand the reasons for reporting to beneficiaries. When you're ready, click the forward arrow to continue. One of the main reasons for keeping accounting records is so that information about how the organization is being run can be obtained. Having already set up accounting systems and budgets, the next step is to produce financial reports to report on and monitor the organization's financial affairs. Providing the accounts are kept in a suitable way and have been checked for accuracy, putting together a financial report is not as time-consuming as it is normally thought of. However, financial reports must be timely, accurate, and relevant. Financial reports are not only needed primarily by those responsible for managing the organization and by current potential donor agencies, but also to a wide range of stakeholders. Project staff need financial information to be aware of how much money and resources are available for their projects and what has been spent so far. Managers need financial information to monitor how project funds are being used, especially compared to the original plans, to help plan for the future. Finance staff need financial information to make sure that there is enough money in the bank to buy things the organization needs to run its programs. Board of directors need financial information to keep an eye on how resources are being used to achieve the organization's objectives. Donors need financial information to make sure that their grants are being used as agreed and that the project's objectives are being fulfilled, to consider whether to support an organization in the future. Government departments need financial information to make sure that the organization pays any taxes due and that it does not abuse its status as a not-for-profit organization. Project beneficiaries need financial information to know what it costs to provide the services they are benefiting from and to decide if this is good value for their community. The general public need financial information to know what the organization raises and spends during the year and what the money is for. You now have a better idea of the many different users of financial reports, both internal and external stakeholders, using financial information for management and accountability purposes. It is not surprising, therefore, that different kinds of reports are needed for different users, as summarized in this table. During the financial year, accounting information is summarized and turned into management accounts for internal monitoring of progress against the budget. At the end of the year, the annual accounts, namely the balance sheet and income and expenditure account, are produced to report on the outcome to external stakeholders. At intervals during the year, an organization will also be required to complete special progress reports to donor agencies. The annual accounts are annual financial statements, the balance sheet and the income and expenditure account, which show in summarized form where money has come from, for what purpose it has been received, how it has been spent, and what the outcomes of operations are. They should be prepared as soon as possible after the end of the financial year, for example within 6 weeks, and made ready for the external audit. The organization's constitution will often specify the deadline for presentation of accounts to the members. The annual accounts, accompanied by the annual report, form the main publicity and information package available and will be of interest to many users. For this reason, the annual accounts should present the organization in the best possible light, help to promote its work, meet the needs of those using the accounts, and meet the requirements of auditors. If an organization's annual accounts show large accumulated funds, it may give the impression that the organization is well-resourced, and donors may be less inclined to give support to new initiatives. There are, however, good reasons why an organization will have cash reserves. For example, funds put aside to replace equipment or a building fund. So it is important to provide an explanation to reassure donors that their new and continued support is needed. When reviewing an organization's financial reports, the main goal is to assess the health of the organization and to make sure that funds are being used as intended to achieve organization objectives. Comparative standards, market results, and targets or prior year's accounts are needed to measure against the numbers on the financial statements. When we interpret the balance sheet and income and expenditure statement, we use 2 types of financial analysis. Trend analysis, which evaluates how an organization is doing compared to the prior period. And ratio analysis, which provides a means of interpreting and comparing financial results. Now, let's take a look a little more closely at trend analysis. Trend analysis takes at least 2 sets of figures compiled using the same accounting techniques and showing information for 2 consecutive periods, usually year on year. By comparing the figures, it may be possible to detect trends and use this information to forecast future trends or set targets. Trend analysis is more meaningful when combined with financial ratio analysis. Financial ratio analysis provides a means of interpreting and comparing financial results. It is used widely in business to assess the profitability and efficiency of companies. Ratio analysis in the not-for-profit sector is less common, but it is nonetheless very useful if adapted to the sector. Ratios allow comparison of reports expressed in different currencies and between organizations of different scale by converting them into a like measure. Donor agencies often use this technique when assessing performance, especially to compare relative costs, such as central administration, between similar organizations or projects. The importance of ratios is in the clues they may provide to what is going on, not as absolute measures of good or bad performance. Ratio analysis helps directors and managers answer 3 important questions. Financial sustainability. Will our organization have the money it needs to continue serving people tomorrow as well as today? Efficiency. Does our organization serve as many people as possible with its resources for the lowest possible cost? Effectiveness. Is our organization doing a responsible job of managing its money? When analyzing the income and expenditure report, you can use ratios by converting each line item into a percentage of total income by dividing each item by the total income and then multiplying by 100. This serves as a guide to the relative importance of different categories on the statement. For example, the relative costs of administration versus direct project costs. This is useful for drawing attention to the important areas and away from insignificant issues. This calculation will also give an indication of the level of donor dependency by dividing the total of donor grants by total income and multiplying by 100. If your financial strategy is leading you towards less dependence on external aid, the dependency ratio will help to set and monitor your target level. A further level of analysis can be obtained by comparing the ratios for the current and previous year's figures to detect trends. When analyzing the balance sheet, you can use the same calculation of dividing everything by the total income figure shown on the accompanying income and expenditure statement to give an indication of the relative importance of items on the balance sheet. A survival ratio can be calculated by dividing general reserves, which is part of the accumulated funds and are unrestricted, by the total income from the accompanying income and expenditure statement. Then, if you multiply the resulting figure by 365, this will give an indication in days of how long the organization could survive in the coming year if income dried up and levels of activity remain the same. Of course, this is a highly hypothetical scenario, as in practice, the organization would contract operations if its income was drastically reduced. The acid test or liquidity ratio asks the question, can we pay off our debts now? It divides current assets minus the less liquid assets such as stocks and prepayments, in other words, short-term debtors and cash balances only, by current liabilities, short-term creditors and overdrafts. The resulting ratio should be no less than 1:1. A ratio of 1:1 suggests an organization has sufficient cash to pay its immediate debts. The current ratio asks the question, can we pay off our debts within 12 months? It divides total current assets by total current liabilities to find a further test of an organization's longer-term liquidity. A result of 2:1 is considered satisfactory. Again, convert the figures for both years shown on the balance sheet to detect significant trends. To download a quick reference guide to ratio analysis, click the Attachments link located in the top right of your screen. When you're ready, click the forward arrow to continue. Managers need financial information throughout the financial year to monitor project progress and manage budgets effectively. If reports are produced on a timely basis, any problems can be addressed early on and action taken to put things right. Ideally, the management accounts should be produced every month and within a few days of the end of the accounting period. Any later, and the information becomes out of date and less useful. The minimum frequency for management reports is once a quarter. Since the reports are produced so that the managers can make decisions about the future management of the organization, the meetings of the governing body should be set to coincide with a management account cycle so that the information is still timely. Now that we have a better understanding of how to interpret financial statements and when financial information is needed, let's take a look at how the financial planning and accounting processes come together to produce management reports. The reports are compiled by taking summarized figures from the main books of account and the budget for the same period. Providing the accounts and budgets have been set up to use the same chart of accounts, codes and descriptions, this should be a very quick process and no additional work is required. The main reports that will be useful to managers are the cash flow report, the budget monitoring report, and the forecast report. click on the Cash Flow Report to learn more. The Cash Flow Report is the cash flow forecast updated with actual receipts and payments each month, plus any new information about future spending or fundraising plans. It allows managers to predict periods when cash balances are likely to be insufficient to meet commitments and make the most of any surplus funds during the year. Where cash resources are limited, it is important to monitor for the ability to pay creditors on time and to take action when there are early warnings of potential financial difficulty. Options available for managing cash flow include: exercise good credit control, for example, follow up on debtors for prompt payment. Review grant schedules. Encourage payment in advance rather than in arrears. Bank all funds received daily. Request special payment terms from major suppliers and stick to them. Pay certain overheads by installment, for example, insurance premiums. Prioritize major payments. Defer action that will lead to additional expenditure, for example, recruitment, taking on leases, and purchasing equipment. And lastly, negotiate an overdraft facility as a short-term remedy. The Budget Monitoring Report, also referred to as Budget Compared to Actual, takes the budget for the reporting period and compares that with the actual income and expenditure for the same period. The difference between the budget and the actual result is known as the variance, which can tell us a lot about what is happening in a project. Variance figures will be positive, negative, or zero, depending on what has happened. Often, budget monitoring reports also show variances as percentages. For example, the amount of the budget or grant used up so far is known as the budget or grant utilization ratio, or the burn rate. To download a sample budget monitoring report, click the attachments link above. When you're ready, click the forward arrow to continue. The budget variance percentage can be calculated in one of two ways. You may use either method, but it is important to be consistent. One way is to divide the budget variance by the budget for period and multiply by 100. Any underspends will result in a positive budget variance percentage, and overspends will produce a negative budget variance percentage. Another way to calculate the budget variance percentage is to divide the actual for period by the budget for period and multiply by 100. Underspends will result in a figure less than 100%, and overspends will be more than 100%. To calculate the budget utilized or burn rate, divide the actual spent by the total budget and multiply by 100. A resulting figure of over 100% means the total project budget is overspent. Forecast reports are especially helpful from the second quarter onwards for predicting the outcome for the year and helping with the budget process for the next year. With a fair degree of accuracy, you should be able to tell whether the organization is going to run a surplus or deficit. This is all important in your relationship with donors. A large deficit can make the organization appear to be out of control and poorly managed. A small deficit can demonstrate a great need and even a sense of good housekeeping. A small surplus can suggest good management. A large surplus can indicate a failure to meet needs or inexperience in budgeting. There are various ways of reducing a surplus at year end, including purchasing new or replacement equipment, ordering stocks of stationery and office supplies. There is very little that can be done about a large deficit except to provide an early warning and a very good explanation to stakeholders, and hope that there are sufficient reserves to cover it. To download a sample budget forecast report, click the attachments link above. When you're ready, click the forward arrow to continue. Budget monitoring reports help to identify problem areas and provide an early warning when key targets are not being met. They may also help detect fraud and errors in the accounts. Here are some key areas to focus on when you review a budget monitoring report. What is the accounting basis of the report? Is it compiled on the cash or accruals basis? Are there outstanding commitments? If so, how does that affect the results? What does the bottom line tell you? Overall, is the budget overspending or underspending? And is it significant at this time in the life of the project or program? An outcome/variance of plus or minus 10% from the budget is considered to be a reasonable variance. What is the result within budget family groups? For example, budget items in the same area such as staff costs, project inputs, and admin costs, etc. Is spending overall on target across the group? Again, if the result is within plus or minus 10% from the budget, this is generally acceptable. Look for unusual or unexpected results. Could this be an indication of a miscoding or abuse? Are there any significant variances in the individual line items? Are the reasons for the differences explained? For example, the miscellaneous expenses budget is substantially and unexpectedly overspent and therefore must be investigated or looked into. Do not just concentrate on overspending. Remember that underspending is just as critical for an organization. Do linked budget line items, for example, activity-related costs, tell the same story or do they contradict? For example, the project materials budget is underspent, suggesting delayed activities, but the vehicle running costs are high, which is not logical. Do the budget report figures tell the same story as the narrative project report? Sometimes the figures just do not look right, so trust your instincts and follow up your concerns. Commitments refer to significant expenses, which have been incurred for a project or organization in a particular period, but haven't yet been accounted for or belong to a future reporting period. Commitments usually occur in a cash accounting system or where there are time delays in reporting all expenditure, for example from field offices. If significant commitments are not taken into account when compiling budget monitoring reports, the results may under or overcount the true level of expenditure and give a distorted view when compared to the budget. It is important to be aware of outstanding commitments when monitoring a budget or grant because decisions are based on the reported variances and balances available. It could appear that there is more or less money available to spend than there really is. Here are two solutions if figures exclude outstanding commitments. Include an extra column in the budget monitoring report to record known commitments. Add a note about known commitments in the comments column or a covering note. Variance analysis involves looking at variations from the budget to identify significant or unusual variances and their causes. This helps us plan the next phase. The first task is to identify whether the variance is a positive or negative one. Positive variances are sometimes described as favorable and negative ones as adverse. A favorable variance happens when actual income is higher than the budgeted amount or actual spending is lower than budgeted. An adverse variance happens when actual income is lower than the budgeted amount or actual spending is higher than budgeted. The next step is to understand what has caused the variance to happen. In all cases, a variance represents a change from the original plan, but what lies behind it? Generally, we can say that variances will be the result of a change in one or more of the timing of the activity, the actual price achieved, or the actual quantity of goods or services taken. Sometimes a variance on a report will be due to an error in the figures rather than a change in plan. For example, a misclassification of expenditures in the accounting records. When classifying variances, use these 3 criteria to highlight where management attention and action is required. This will help decide if the variance is temporary or permanent, meaning, will the variance continue or will it work out through the system over time? Variances caused by a change in the planned timing of an activity, for example, due to delays or rescheduling, are described as temporary variances because they will most likely work themselves out during the course of the year. These are therefore generally less of a concern and no corrective action is required. For example, a project plans to purchase a vehicle in month 1, but it is held up at the port by customs. The budget monitoring report will therefore show a positive variance on the vehicles line because the budget has not been used yet. By month 2, the vehicle arrives and is purchased, just a bit later than planned. The budget monitoring report will no longer show a 0 spend on vehicles, and the previous variance will be gone as it was a temporary variance due to a timing issue. Variances caused by changes in the price or quantity of particular budgeted items generally fall into the permanent variances category because once this has happened, there is no going back. The only way to recover the situation is to make an action plan, for example, to reduce spending on future items. These variances are therefore generally more serious and management attention and corrective action is required. For example, the invoice for a vehicle is paid in month 3. The price of the vehicle has increased by 10% due to a fluctuation in the exchange rate. The budget monitoring report for month 3 now shows a negative variance on the vehicles line equal to the difference between the budgeted price and the actual higher price paid. This is a permanent variance caused by a change of price. A decision has to be made on how to fund the additional 10% on the cost of the vehicle. Having analyzed the figures in management reports, it is then important to work out appropriate corrective action if needed. This table summarizes the actions open to managers to take on variances, once analyzed using the classification systems described earlier. When there is a positive temporary variance, you will want to monitor progress and plan to spend if activity is delayed. With a positive permanent variance, you will want to increase activities and reallocate funds if donor rules allow. When there is a negative temporary variance, you will want to delay future budgeted costs and consider cash flow implications. With a negative permanent variance, you'll want to use reserves, cut costs, and reduce operations. Deciding on the action to take will depend on many factors, including knowledge of the project, where it is now and what the activity plans are for the next period. Awareness of external factors, for example, inflationary trends, dependence on other programs meeting their targets. How serious the variance is. How controllable or otherwise the budget items are. What the impact would be to take no action. And donor rules and conditions. It is useful to use a budget management action planner table to help you manage and control your budget. This table is an example format that can be used to discuss action plans with your manager and the project team and to monitor progress of the action plan. The line item description will list the budget line that requires some corrective action. The variance percentage or monetary value should include items that exceed plus or minus 10% variation from the budget and which represent a significant sum. The variance type will be either permanent or temporary. Remember that temporary variances will work their way through the system but very large ones might still have an impact, for example on cash flow. This column specifies to what extent can you control the use of the budget. For example, to restrict its use or make savings if overspent, or stimulate its use if underspent. This column lists the impact on project and grant management if not corrected. For example, cash flow, achieving targets, meeting timeframes, and allowable costs. You should also include a column to list what action should be done and by whom. This will help to minimize the impact and get the project back on target and/or to meet donor requirements. For example, budget reforecast or adjustments. Advise donor of delays or request no-cost extensions. Request unrestricted funds to cover overspends. Change activity plans. Put efforts into reducing costs or stimulate spending, etc. It is worth remembering that donor agencies are themselves accountable to stakeholders, trustees, government, taxpayers, etc., and they rely on you to provide them with the information they need. Financial accountability requires that you demonstrate to the donor that their funds have been used for the purpose for which they were intended. The reference point is the original funding application, and guidelines are usually provided with a confirmation of grant aid and the contract or agreement signed by both parties. It is important to comply with the conditions and meet reporting deadlines to establish credibility and encourage confidence, and to make sure your grant arrives on time. It is important to check on what you have agreed to do as part of the agreement for funding from each of your donors. Conditions imposed by donors vary enormously, but can include progress reports, frequency, format and style of reports, usually quarterly to coincide with release of grant installments. Scope and designation of funds, what funds may or may not be used for, whether funds can be carried forward from one financial year to the next. Administrative overheads, the specific items that are allowable or excluded, or a percentage limit based on the total grant. Budget line items, specific budget headings or account classifications which correspond with the original grant application. Rebudgeting policy, for example, permission or otherwise to transfer surpluses in the budget from one budget line heading to another, and within what limits, usually a percentage of the total. Accounting method, accruals or cash accounting. Bank accounts and interest. Separate bank accounts are required by some donors and/or they do not allow you to keep any interest earned on sums invested. Depreciation policy, how to treat fixed assets purchased with a grant. External audit. Some donors require a separate external audit. Donors require that an organization is able to demonstrate financial soundness before granting the release of funds. This is why the donor report is so important. In most cases, the report will include a budget compared to actual summary, accompanied by a narrative report on the activities being undertaken. When there are several donors, it is important to set up the accounting systems so that the information required by the donor agency can easily be retrieved. Otherwise, the organization will be involved in a tedious information-gathering exercise every time a report is required. When putting together a report to donors, do meet reporting deadlines or request an extension. Produce accurate and verifiable figures. Not conceal underspends or overspends. Explain any significant variations. And keep the donor informed of any potential problems. Finally, bear in mind that donors have a lot of experience of working with groups like your own. They will almost always respond positively to requests for advice. We spend a lot of effort when preparing reports, so it is important that they are used and not just set aside. Spend some time thinking about who the reader is and what they will find most useful. Remember that managers and board members are busy people and they rarely have the opportunity to read all reports that get sent to them. With financial reports, it is a good idea to provide an exceptions report, a brief cover note that draws attention to key areas that need decisions. The exceptions report is usually no more than 1 or 2 pages long and should avoid using technical jargon. It should be brief and easy to read. A suggested layout includes an overview of the period being reported, for example, dates covered, how figures have been compiled, what activities are covered by the attached reports, and author of the report. Also highlight the most significant variances from the budget and explain the reasons behind the variances. This should not just concentrate on overspending of budgets. Underspending can also be a problem, especially when related to donor-funded projects. And include recommendations for action, that is, corrective action required to deal with the key issues identified earlier. For example, strategies to avoid a cash flow crisis in future months, revised activity plans to get projects back on target, and restricting use of vehicles where running costs are over budget. When presenting negative figures in financial reports, they can be represented in 2 ways, either negative $1,234 or $1,234 in parentheses. Alternative formats include graphical formats such as a bar chart for a budget actual report as shown in this example. A pie chart for an income and expenditure report is also another example of an acceptable format when presenting tables of figures, especially for people who are less confident around figures. Similarly, rather than presenting actual figures, you might simply present a list of statements, such as in this example of an alternative standard balance sheet format. Milestone project financial position on December 31. Our program equipment and vehicles, after a deduction for wear and tear, had a value of $112,091. We had $8,095 help as cash and in the bank. The Smile Trust owed us $10,000 for the final quarter grant, and we had some outstanding fees and other small amounts owed to us, totaling $2,459. We owed a total of $3,262 in unpaid invoices. This means that if we paid off everything we owe from our available funds, we would have $17,292 to continue our operations. Our overall reserves, including the value of our equipment and vehicles, total $129,383. Most organizations recognize the need for downward accountability, for example, reporting to the communities they work with. But few have set up systems to deliver it. Most organization systems focus on upward accountability, such as reporting to donors, boards, and management and head offices. To participate fully in an organization's work, beneficiaries need access to information about the organization's plans, resources, and activities. Increasing transparency and accountability to beneficiaries has many benefits, including strengthening trust and respect between organization staff and beneficiaries, improving the quality of program decisions, as beneficiaries provide feedback on how funds are being spent, empowering beneficiaries to make their own decisions on their own behalf, reducing the risks of inefficiencies and fraud, and encouraging finance staff to get more involved with organization fieldwork. Introducing this level of financial transparency may naturally hit some obstacles, such as adding to the burden of already busy staff. But the benefits generally far outweigh the costs. Some good practice ideas on how to practically report to beneficiaries include making information easier to understand by using graphical presentations and using display boards outside offices to display budgets, the amounts of funds available for each area, and a monthly update of expenditure. To recap what we covered in today's lesson, you should now have a better understanding of the key elements of financial reporting. Explain how to interpret financial statements using trend and ratio analysis, and how to compile and use the information in management accounts. Today you learned the important features of donor reports and are aware of the reasons for reporting to beneficiaries. Congratulations! You have reached the end of the module. Please take this time to revisit any of the content we covered today. When you are ready, click the Home button to return to the main menu.